December of 2019, news began breaking of a new flu-like coronavirus, known as COVID-19, that was spreading through Wuhan, a city of over 12 million people that is China's fifth most populous. The next few months have been chaotic for the global economy, with companies closing locations throughout China, the most populous country on Earth, as well as facing issues manufacturing products as factories across China were unable to produce goods to export internationally. As the coronavirus, now a global pandemic, has spread across the world, with many countries closing their borders and some even imposing mandatory nationwide quarantines, industries dependent on travel and tourism are grinding to a halt. Now as schools close across the United States and Americans begin to embrace social isolation, small businesses are losing customers and the US stock market is beginning to take a hit. Hello and welcome to That Is Interesting. I'm your host Carter. Today, with recent stock market drops perhaps foreshadowing a recession, the question is being raised. What is going to happen to the economy of the US and the world as a whole, and how does it compare to past economic crises throughout history? The first market drop took place on February 24, 2020, as the coronavirus began quickly spreading outside of China. It was a major crash, and in the days following, more occurred, including the largest drop since the 2008 Great Recession. But in the following days, prices started to go up once again. That changed on March 8th, when a disagreement over oil prices had major implications for the stock market. Fears about the coronavirus were keeping people at home, staying out of cars and planes, both of which rely on oil for power. Price is governed by the law of supply and demand. Products in high demand and low supply will be more expensive, whereas products that there are plenty of but that no one wants will be cheap. And so as demand for oil plummeted, so did the price. Oil was becoming cheaper and cheaper, so Russia, a major oil exporter, and OPEC, the Organization of Petroleum Exporting Countries, an association of oil-rich nations such as Saudi Arabia, Kuwait, Nigeria, Venezuela, and Iraq, held an emergency meeting with the goal of cutting oil production. With less supply, the decreasing demand for oil wouldn't continue to affect prices. But Russia and OPEC couldn't reach an agreement, so Saudi Arabia doubled down, cutting prices of the oil they produced and initiating a price war with Russia that dropped global oil prices by 30% and hitting the stock market with a 7% drop. 3 days later, after US President Donald Trump announced a ban on travel from Europe, the market dropped another 10%. 4 days later, these drops were followed by another fall of 12%. Since February 24th, the US stock market has suffered a massive decline. But how does it compare to past economic crises? One major difference is that, as of when I'm writing this, the United States is not in a recession, but a bear market. The difference is simple. A bear market means a declining stock market, whereas a recession means a declining economy, specifically 2 quarters or half a year of declining GDP growth. Simply put, a recession is brought on by a country's businesses and citizens making and spending less money and manufacturing less products. While bear markets and recessions often go hand in hand, a bear market is more common, impacted more by news and fear than economic trends. Yet at the rate that coronavirus is spreading, with officials claiming that it could last for several more months, it is almost certain that the economy will face continued GDP decline and that the current bear market will be coupled with a recession. The US hasn't been in a recession since 2008, when the Great Recession, the worst in the US history since the Great Depression, in the 1930s, affected the global economy. The Great Recession was triggered by the housing bubble, which had grown due to decades of the US government incentivizing home ownership and deregulating banks. This deregulation allowed banks to sell mortgages, or loans people take to buy a house, to one another in large bundles. But as home ownership became more popular with everyday people, and as the sale of mortgage bundles became more popular with banks, potential homeowners began taking out mortgages who had a history of not paying banks back, or just didn't have enough money to ever pay them off. But banks traded in these mortgages too. Meanwhile, more people were buying houses. With greater demand for them, houses just kept getting more and more expensive, creating the housing bubble. But all bubbles eventually burst. This one, built on the flimsy theory of trading worthless mortgage bundles, burst in December of 2007. Businesses closed, people lost their jobs. Some large banks like Lehman Brothers completely went out of business. Others had to be bailed out by the government. People couldn't afford to spend as much money, and the economy slowed into a recession. one of the worst in U.S. history, that lasted for a year and a half. The Great Recession had political ramifications too, sparking the rise of the Tea Party, an anti-taxation wing of the Republican Party that emerged in protest to the spending of tax dollars on bank bailouts. The beginning of the 21st century was also the beginning of the internet. People investing in the stock market predicted correctly that the internet was going to be a major success, and that internet companies were going to make a lot of money in the future. People started investing in websites left and right, and the prices for internet companies on the stock market kept going up and up. Anything with .com on the end seemed like a smart purchase. Except the problem was, the internet had only been available to the public for 9 years. Plenty of internet companies were untested, or were just bad ideas to begin with. In 2000, the flimsy internet companies started to perform poorly. Their prices plummeted, taking the stock market down with it. This was known as the dot-com bubble, and it led to an 8-month recession. In 1973, a financial crisis was caused by an oil crisis. It began as a result of the Yom Kippur War, a war between Israel and neighboring Arab nations. The United States supported Israel, and in retaliation, numerous oil-rich Arab countries refused to sell oil to the United States and several other countries, such as Canada and Japan. The US and other affected countries lost much of their oil supply, and oil prices quadrupled. The economy tanked, creating a recession in which the US suffered gas shortages, and massive lines of cars waited to fill up at gas stations, and major flaws within the existing economic system were exposed. A bad economy is often attributed, rightly or wrongly, to the president, and sure enough, the next two presidents in office, Gerald Ford and Jimmy Carter, served only a single term. But the worst recession of all, the Great Depression, started in 1929. The Roaring Twenties, as the decade was known, had a great economy, with stock prices going up and up and up. Americans started realizing that if they invested in the stock market, they were bound to make money. Previously, only very experienced investors participated in the stock market. But in the 20s, the market was doing so well that everyday Americans could invest in it without needing any background knowledge. Soon, everyone was investing, putting money in any stock, and just watching it go up. This speculation that the market was going to just get better and better made a lot of people invest and made stock prices go up. In the 5 years before the Depression, prices became 5 times higher. This speculation in the success of the market was similar to the speculation in the success of the internet and the housing market. The true value of these companies were not being represented in their prices, and the market was bound to correct itself. The bubble burst in October of 1929, and the market would fall by almost 90%. Banks couldn't pay people back, and those who'd lost their life savings couldn't spend money elsewhere, meaning other business owners weren't making as much as they used to. The market crash brought down the entire economy with it, in the US and the world. A quarter of Americans would be unemployed. In those difficult economic times, Americans lost faith in how their president handled the situation. President Herbert Hoover was easily defeated for re-election by Franklin Delano Roosevelt, whose policies helped get people working again and breathe life back into the economy. Even more consequential to ending the Depression was World War II. All of a sudden, people all over the world could get jobs building planes, manufacturing weapons, or serving in the military. Unemployment fell back down again, and America returned to a new time of prosperity. While these recent market drops look almost certain to lead us into another recession, I doubt it will be as bad as some of the recessions I just talked about. Periods of economic growth usually last much longer than periods of decline, with some of the recessions I discussed previously going on for only a year or so, or even less than a year. It may, like some others, have an effect on the upcoming election. When the economy is doing well and people are doing well, they have less of a desire for change, for the unexpected. In strong economic times, the incumbent president usually wins re-election. But in years when people are having financial difficulties and they feel like the president isn't doing enough about it, they'll have no problem voting to elect someone new. As this recession will fall during an election year, Trump's handling of the crisis might seriously help or seriously hurt his chances of winning re-election in 2020. This recession is also different than the others. While the Great Recession, the dot-com bubble, and the recession of the 1970s, and the Great Depression were all caused by flaws within the economic system, The recession we are likely heading into is caused by a disease. Planes aren't flying not because of anything wrong with the economy, but because people don't want to risk catching the coronavirus. That's the same reason people aren't going to work or spending money. The economy is stalled because people are staying at home. And don't get me wrong, staying at home is exactly what people need to be doing to prevent the spread of the coronavirus. We need to live with the fact that a recession is going to be a necessary side effect of staying safe and healthy during the next couple of months. But what it also means is that as soon as the disease is no longer a threat, as soon as people start traveling again, as soon as companies start manufacturing and shipping again, and as soon as people are able to go back to work, the economy should start right back where it left off. Thank you for watching this video, and I hope you learned something new. Subscribe for more content like this. I cover the countries, cities, people, and places of the world and beyond. These videos will leave you saying, "That is interesting."